We are starting our series of discussing each behavioral bias one by one with the disposition effect. Disposition effect is probably most common behavioral bias for individual investors. Even myself, after so many years of trading experience, am vulnerable to this bias. The disposition effect is defined as individual investors' tendency to close winning positions too early and to hold on losing positions for too long. It may appear irrational behavior at the first glance. However, it usually works to the detriment of individual investors. Usually, those winning positions that individual investors tend to close too early tend to make further profits. And those losing positions, which individual investors hold on for too long, continue making further losses. The first empirical evidence documenting the disposition effect was presented by this study in 1998 ODM. He obtained the trading records of 10,000 individual investors at a US brokerage firm. Here is the analysis of the data. In the upper table, in the last column on the right, we see that the probability of an individual investor closing a winning position is 15.2%, whereas the probability of closing a losing position is only 9.4%. The difference between them is statistically highly significant. So, individual investors are much more likely to close winning positions compared to losing positions. It may appear irrational behavior. You're just realizing your gains. And you're keeping the losing positions with the hope to recover. However, as we see in the lower table, this behavior works against the individual investor. It is detrimental. In the lower table, we see the performance of those winning stocks which individual investors sell too early and those losing stocks which they hold. Over the next 84 days, that is next 4 months, the winning stocks that individual investors sold continue to earn another 0.48%, whereas the losing stocks they hold continue to lose another 0.56%. Over a longer horizon, up to 1 year, as we see in the next column, the discrepancy becomes wider. The winning stocks which individual investors sold continue to earn 2.35%, whereas the losing stocks they hold continue to lose 1.06%. So this behavior, although at the first glance appears to be motivated, taking profits and rational, works against the detriment of individual investors. Those losing stocks that they continue to keep provide further losses, but those winning stocks which they sold continue to go up and provide further gains. So this is an irrational behavior. So usually, behavior that cause losses are irrational and driven by behavioral biases. The disposition effect is a behavioral bias that results from our fears and hopes. When we have a winning position, we have the fear of losing those profits. This makes us to be motivated to close them as soon as possible, without thinking more carefully about further gain potential. And when we have a losing position, we usually have difficulty of accepting a failure. So we postpone this unpleasant decision as far as we can. So the failure to close losing positions on time to avoid further losses is driven due to a psychological misperception. Psychologists have provided further insight about this behavioral bias. Usually, people make their decisions with respect to a reference point. For investors trading in the stock market, the reference point can be their purchase price. When they are above their reference point, so above their aspirations to make some profit, then they want to secure those gains as soon as possible. So when they have a winning position, until they realize their profit, they have a strong psychological discomfort due to the fear of losing it. This forces them to act too quickly without considering a more detailed analysis, without making a more careful forecast about whether there is any future gain potential or not. They close their position. On the other hand, when they have a losing position, they don't want to realize it because it's a painful decision. It's a discomforting feeling to realize a loss, and they don't want to face with it. And this psychological feeling prevents them from conducting a better analysis to try to forecast whether the losing position may go further down, causing further losses. Rather, their decisions are driven by their feelings and moods, and therefore they keep these losing positions. And as we have seen, this decision usually doesn't turn out to be rational. Individual investors would have been better off if they had kept their winning position for a little bit longer, and if they had closed their losing positions on time to avoid further losses. Now, we can see what would be the impact on the general market if many individual investors display this bias. The consequence would be underreaction. So let's imagine a case whereby a stock trading at $10 per share receives good news, which requires the new stock price to be around $20 per share. So suppose informed investors get this news and react to it and drive the stock price up, but not immediately to the $20 level. Let's say $16 or $17. At this point, there is still some margin to make a profit. An investor buying this stock at $17 will make a further profit of $3 until it reaches its new full equilibrium level at $20. However, individual investors, instead of analyzing this new information and acting on it, would be driven by their instinctual behavioral bias to take their profit as soon as possible. So instead of buying at this point to drive the further potential, they just close their position and sell at this price. Obviously, this stock which they sold would perform further gains up to $20. So this is a suboptimal decision and damages individual investors' trading performance. If many individual investors commit this bias, then there will be a selling pressure in the market, preventing the stock price to quickly adjust to the $20 per share level. Rather, it will be delayed. It will take longer time until the selling pressure coming from these individual investors is over and more informed investors act to exploit the remaining increased potential. So, the consequence is a slow response of the price, a gradual uptrend, a momentum in the stock price. So this is an anomaly we discussed at the beginning. So in this session, we have learned that one of the causes of the momentum profits could be a large number of individual investors' disposition.